Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Brian Frank, Chief Investment Officer at Frank Funds, to discuss what to look for in small and mid-cap investments without falling into that value trap. Brian, it's great to have you with us. Welcome to Trade Talks.
Thanks for having me, Jill.
Let's discuss that. What are your views on value? What are you looking for?
I think value's definitely changed a lot over the years as passive investors have won market share. So there are no analysts at the large passive investing firms looking for good earnings reports or hidden gems. So if you find value, you have to make sure it gets unlocked. So we've definitely switched more towards cheap companies that have a catalyst to unlock that value, because you can just end up in a value trap if you don't have anybody looking to give you that value to shareholders.
Mm-hmm. Well, sometimes stocks are cheap for a reason, right?
That's true. That's a different kind.
When you think about it, what sectors would you be looking in within the small and mid-cap space?
So right now at Frank Funds, we're a bit bearish on the economy. We think the inverted yield curve and the leading economic indicators being negative is telling the truth. Investors might be excited that stocks are going up. So our sectors are more defensive. We're looking more at consumer staples and utilities. You got to be really careful there, though, because there's some expensive companies as well. But given the latest run in technology stocks, value's gotten a bit cheaper, and there are some places to hide, we think, in a recession.
Well, it's interesting you bring that up because, of course, you have risk concentration when there's just 7 to 11 names that are really moving the market here, and there are some really interesting deals in the value space right now.
Yeah, you look where nobody's looking. I mean, in 2022, when technology stocks were crashing, we found some gems in the wreckage there, and nobody wanted to buy them at that point. And now that some of those names are up over 100%, everybody wants to buy them, but that's not the way to make money. So now that value's gone out of favor again, it really does remind me of 2021 with these growth stocks running, value being left for dead. It's a great setup for more value outperformance. And
you brought up recession before. I feel like this is a recession that everyone's waiting for and hasn't happened. I mean, we don't know if we're in one now technically, but what are some of your concerns there? Is it a result of, you think credit is tightening? I mean, the job market is still firing on all cylinders?
Yeah, I think you nailed it with the credit. Credit is definitely tightening. Banks are losing deposits. They don't want to sell, their underwater bonds with duration on them to meet those deposits because that would destroy equity. So they're not lending as much. And banks, especially small and mid-sized banks, are the backbone of this economy. They give credit to small businesses, which are the ones that hire people. And in terms of those labor numbers, I'd be very careful because we're seeing quite a few revisions downward, which is what you tend to see going into a recession. Strong labor report, and then it gets revised downwards in the next few months.
What do you think of the inflation data that we got yesterday and today?
I think it's a mixed bag.
Right.
I think the headline is benefiting from the fact that energy has come down so much over the years, but I think energy is a bit more sticky. We're definitely not drilling more, we're definitely not refining more in this country, so I wouldn't expect oil to get a whole lot lower permanently from here and benefit that headline number. And that core number, I don't know, 4% is still pretty high in the eyes of the Fed, so I expect them to be talking tough.
As a consumer, though, I don't feel like inflation is under control. Prices seem as high as they were even just a few months ago. I mean, look at rents. Rents in the suburbs now are, you're paying rents that are almost equivalent to what you could get in smaller cities.
Oh, it's crazy, and it hurts. And it definitely hurts a big subset of the consumer economy. And I don't think it's just rents. The way that inflation works is if inflation's 10% and it goes down to 1%, that doesn't mean your price went down by 9%. That just means it's going up by another 1% this year. So unless we're going to get deflation, which is pretty bad in terms of the economy and what the Fed would not want to be looking for, prices probably won't come down much from here.
I mean, do you think retailers are really going to correct prices that much anyway? The consumers used to spending and getting less. Shrinkflation is another thing as well. I just can't imagine many of these packaged good companies rolling back unless there's competition within the brands.
Yeah, I think it would definitely take a lot of competition, and it also takes a weaker consumer. We've heard the CEOs of Costco and Walmart talking about consumers trading down, but that still doesn't necessarily mean they can lower their prices. They do have, to an extent, a tight labor market, and they also have goods inflation and transportation inflation to deal with.
Yeah. All right. Appreciate the insight, Brian. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.